At Numerian Capital, we bring you the latest stock news each day. Please like and subscribe so we can bring these articles to you each day. Thank you.
Today, December 1st, 2022, expect INTC stock to stay in a slump for quite some time. INTC stock may not have a recovery until 2024. Intel has given back most of its post-earnings boost, and could be at risk of sliding back past its 52-week low. Coupled with unappealing near-term prospects, it's questionable as to how long it will take for the chipmaker to, possibly, make a recovery. With better choices out there among semiconductor stocks, continue to skip out on INTC. Falling back to $30s, Intel, Nasdaq INTC, stock has already started to give back its post-earnings gains from earlier this month. This is not surprising. In my view, this extreme move higher for INTC stock after its latest quarterly earnings report made little sense. With this, it appears the market is starting to take off the rose-colored glasses. Investors have resumed viewing the company with a more critical eye. As recent sell-side analyst reports have argued, a turnaround for this floundering chipmaker is going to take to, possibly, prove successful. In the meantime, the semiconductor market downturn will keep weighing on both Intel's operating results, as well as its share price. The stock could slide back to its 52-week low, then onto even lower prices. Far from a great opportunity to go against the grain, this is a situation where it's best to stay away. Intel, $30.07. INTC stock and its likely further move lower. With a trailing price-to-earnings ratio of 8.9, at first glance you may think Intel shares are already dirt cheap, with little downside risk. However, take a closer look at the details, and you'll quickly think otherwise. On a forward basis, based on full year 2022 estimates, INTC stock trades at a much higher multiple, 14.1 times earnings. Compare the current stock price the sell side's 2023 earnings forecast, $1.25 per share, and INTC ceases to look like a value play. Instead, shares appear pricey compared to uncertain prospects and are primed for an additional correction in price. The semiconductor market as a whole is now expected to experience a 4% contraction during 2023. As chip demand keeps softening across the board, there's a strong chance Intel's results for 2023 are in line with, or fall short of, current estimates. The continued drop-off of INTC's earnings next year is more than enough to push the stock below its 52-week low, $24.59 per share, and perhaps toward the low end of analyst price targets, $18 per share, although the stock's high dividend rate, $1.46 per share annually, could limit the chances the stock falls to sub-$20 per share prices. A tough road ahead for Intel. Despite the concerns raised above, you may still be interested in going contrarian and buying INTC stock. You may be willing to put up with further volatility in exchange for potential upside if the company's turnaround plays out. Feel free to pursue this, but again, keep in mind that Intel faces a long and uncertain path to a turnaround. At least, that's the view of Cowen analyst Matthew Ramsey, who stated in a recent research note that 2023 and 2024 stand to be exceptionally difficult years for Intel. This is not only due to the current slump in the semiconductor space. The fact that competitor advanced micro devices will likely grab additional market share at Intel's expense is an additional hurdle. As Investor Place's David Modell wrote on November 11, another sell-side analyst, J.P. Morgan's Harlan Sur, has a similarly bleak take on the company's turnaround prospects. That is, Sur believes it'll take Intel several years to regain lost market share. Although Intel's management is pursuing other ways to improve the company's financials, namely cost-cutting, these efforts could fail to outweigh the aforementioned economic and competitive challenges. The verdict: in the coming year, Intel's fundamentals could deteriorate further. INTC in turn may move lower in response. Over the next few years, the company may make far less progress in improving its operating performance than optimistic investors currently anticipate. Cost-cutting may enable INTC to maintain its high dividend, yet this alone will not prevent continued decline for shares. Collecting that 5.05% yield will feel far less profitable if shares take another double-digit tumble over the next 12 months. While shares have fallen significantly since the start of the year, this stock is far from being a bargain. There are many other stronger opportunities out there among semiconductor stocks, including 7 that are poised for continued growth. If you're bullish on this sector, consider them instead, and continue to skip out on INTC stock.
Thanks for watching Numerian Capital News. Please come back tomorrow for another stock news update. Thank you.